We'll start off. I've just introduced you to Ben. He's a Senior Investment Strategist for 7IM, and Chris, who's Head of Intermediaries at 7IM. They're going to talk to us about the market impact of COVID and how do we pay all the money back. At the end of that, we'll have loads of time for questions if you want to, but also as we're going through it, if you've got anything pertinent, then put it in the chat and then Chris will read it and bring in that particular question when it's relevant and so on. But other than that, we'll wait until Ben's actually finished his presentation, and then we'll do a verbal Q&A. And then at the very end of all of that, if you can be bothered, then you can hang around to see Raj perform a market crash scenario. So I think it's over to Chris then.
Thank you, Sandra. Could we have access to put the presentation up? Ben, if you could perhaps do that, that'd be great.
Yeah, I just need screen sharing enabled. I am now the host. Excellent. What a day.
So as Ben's just doing that, as Sandra just mentioned, obviously Ben's job title does what it says on the tin, you know, behavioural economics expert and investment strategist. Head of intermediaries sounds a little bit like something that's been picked up off of LinkedIn. So I should probably just qualify what I do. Other than being a Toastmaster and compare for Mr. Kumar, my job on a day-to-day basis is just to run a team that support a number of different planners at 7IM. So I've still got a handful of relationships that I manage personally. But generally speaking, it's looking after everything from business development to discretionary relationship managers to platform service managers and so on. So it seems sensible to have both of us on here because I think as Ben manages his way through talking about behavioural economics, there's a couple of bits in particular that we've found planners have made good use of, and a couple of pictures that we'll share later on. So without any further ado, Ben, if you can just go onto the agenda so I can run through what we are going to be covering off. Introductions we have done. Clearly, the very fact that I'm sat here in a bedroom in my house talking to you is enough of an introduction, I think, as to what has happened over the course of March in particular. We thought we would kick off by looking at the UK, because from feedback from Sandra and Raj and from the other planners and Truth users over the course of the last month or so when we've been doing these events, there's a lot of interest in things like QE, inflation, interest rates, and the outlook for the UK economy specifically. Given the fact that obviously all your clients' liabilities are in that, it makes sense to cover it off in detail, so we're going to do that. We're then going to jump on to looking at scenario planning. So what does the future look like? And we'll ask Ben to get the crystal ball out. Market levels and investor behaviour, very much as stated. I think looking at some of the concepts of what's going on between the ears of investors at the moment is quite a nice way of then working out perhaps how we can allay some of those fears, particularly from the managing emotion side of things and the and some of the pictures and tools that we can use in order to do that. And then we're going to finish off with a reference to a historical figure that we think echoes very nicely with what's going on at the moment. So I won't take up any more time as we're already at 2:10. We think this will last about 30 minutes and then we'll have good time for questions afterwards. But please do raise your hand or put anything in the chat function throughout, and then I'll make sure I hold Mr. Kumar to account if there's anything pertinent you want to ask. So Ben, over to the UK economy, I think, to start with.
Cool, thanks, Chris. Just quickly, Raj, Sandra, I'm just admitting people when it keeps telling me they're in the waiting room. So if you, as long as no one is going to kind of illegally sneak in, you're happy for me to do that. Oh, Mark Raybold, good to see you. I'll crack on and keep doing that and while I'm talking. So, right, let me see. Here we are. So the UK economy side of things, if you put your screen over to the right-hand side, which is what I've done, you need to move it over to the left so you can see the sharp drop-off in retail sales. There's a noise coming. So if someone's not on mute, could they? You know, I could have put any chart up here for the UK economy. You know, it could have been GDP, it could have been PMI indicators, it could have been consumer confidence, and arguably it could be anywhere in the world, not the UK. The point is that we have seen an unprecedented kind of crisis, right? We have seen the biggest shock to the UK economy since at least the Second World War, if not ever. And that is the kind of bad news, right? We all know it, as Chris said, everyone knows. knows what the problem is. What that does mean, though, is that everyone knows what the solution is. So unlike the financial crisis, 2007, 2008, governments didn't waste time responding. It's because it's such a simple crisis, right? In 2007, 2008, someone had to sit politicians down and explain to them what a mortgage-backed security was, and then explain why they were running out of control. The complexities of it meant it took a long time before governments and central banks could act. That's not the case today, right? You saw yesterday from Rishi Sunak the announcement of further measures, and we've never kind of seen measures like this, but they're all trying to address the same problem, right? Get the economy back to work, make the recession as shallow as possible, keep the impact contained. Whether it's the furlough scheme, whether it's making sure that banks could have access to lending, companies could have access to lending, even helping the hospitality sector by saying VATs at 5%. All of these policies are kind of throwing everything you can at the economy to keep it afloat. And that's good in terms of jobs versus what could have happened, good in terms of growth, in terms of what could have happened. The policy response has been so big, in fact, that it couldn't be described as targeted, right? This was not okay, we'll address specifically the problem. It is throw everything we've got at this. And what that leads to, kind of despite the low interest rates, which we'll come on to, is a spike up in debt, right? The UK government this year is going to borrow, I forget where the numbers are now, they seem to go up every day, but whether it's 160 billion, I think 160 billion has been borrowed in the last couple of months. That was going to be only 55 billion of borrowing was going to happen in the whole year. It's thrown all budget plans out, it's thrown all preparations out. You can see that the public sector net borrowing as a percent of GDP is now heading very, very sharply towards 20%. The last time we were up here was when we were trying to recover from the Second World War, and indeed fight the Second World War. Now that leads to some interesting consequences, right? Because although the stimulus is going to be good for the economy, that debt pile does not go away. And that, I think, starts to worry people. We see questions quite often coming in about, what does this increase in debt mean for the UK economy? And alongside that, we have questions like, what about QE? What is that going to do? What about the Bank of England printing money? So it's probably worth spending a little bit of time discussing our views on that. When it comes to how do you pay down the debt, there's kind of two things you can do as a country. You can grow, and as you grow, your GDP grows, your borrowing reduces, and you pay down more and more of the debt. That is definitely an option, right? But it takes a long time. It's like if you've got a credit card, paying it off as you get salary increases year after year after year is effective. You'll end up with less debt, but it's not a particularly quick process. The thing that worries people about inflation is that countries have an option that you don't when you've got your personal borrowing. Countries can just print money, right? They can tell the central bank, the Bank of England, to print money and then go and buy government debt. From nowhere, the money is created. Printing's actually kind of a bit anachronistic, right? No one's actually printing the bills anymore. You're just saying that bank account now has £100 billion in from nowhere. And that's what the Bank of England has done. It has bought probably an extra £200 billion worth of UK government debt. Now, usually, when central banks start buying their own government's debt, people get very worried about inflation, right? Zimbabwe is kind of the most recent example. It printed loads and loads of money, and suddenly its currency is basically worthless, and inflation is at about 1 billion%, and people are carrying wheelbarrows around to buy a loaf of bread. That kind of situation is unlikely in the developed world, even in normal times, because there are such a good understanding of that. But actually, that kind of runaway inflation that gets people worried is even less likely this time around, because the thing that causes currencies to devalue and prices to rise so sharply is when investors in other parts of the world get nervous, right? They get nervous about the high level of debt that a country has got into and thinks the central bank's going to print its way out. But if you look at the rest of the world now, every single country, certainly the major ones, and a lot of the minor ones, have done exactly the same thing as the UK. This isn't the UK suddenly issuing a load of government debt to stimulate its economy and then seeing what happens. This is the whole world, right? America can't look at the UK and go, oh, they're being a bit irresponsible with their government debt, because America's done the same thing. So has Europe, so has Japan, so has China. So from a kind of money supply side of things, from a central bank quantitative easing, money printing side of things, we are not that worried about inflation spiking up, because there's nowhere to run to. There's nowhere that has been kind of, fiscally prudent and not issued loads of bonds. It's the global response to the coronavirus that means inflation, runaway inflation, is not particularly troubling. From the longer term, I think it's probably important to say just a couple more things about inflation as well. We've spent a long time, I think, in this country getting used to the idea that, the bank is targeting inflation at 2%. And again, it's a global phenomenon. Inflation at 2% is pretty much the target for every global central bank. And that's really, really important to think about, because when we use inflation for our modeling, inflation and growth, you need to have some confidence in the number you put in. Now, I think that the inflation targets of 2% from central banks are really, really, really good things to use. Number one, because these guys know what they're doing and they know how to target inflation. And number two, because the risk is to the downside, right? Central banks are doing everything they can to get inflation up to 2%. The chances of it spiking higher are very, very low, even given the recent activity. And the inflationary forces at work in the world are just not as powerful as they were even 50 years ago. I'll give you a quick example. 50 years ago in the UK, food and kind of household basics were about 30% of the inflation basket. And food prices kind of kept going up, or at least were fluctuating wildly. Now, food and household basics is about 10% of the inflation basket, because we spend more on things that are essentially discretionary, right? We are not as close to subsistence living as we were 50 years ago. People go and buy, so in the inflation basket now, you've got things like the new iPhone. And yeah, there's going to be another one out in 2 years, but the prices aren't going to increase that much. If you look 50 years ago, people were buying things like gas fires, and those prices were going up. People were buying things like iron bedsteads, right? That was their discretionary goods, and that's just not the world we live in. If you want to buy an iron bedstead now, it's going to be some sort of fancy antique one. It's going to cost you like $2,000. Whereas actually, we all know that if you buy a bed, you're going to go to IKEA and you're going to get something that you can't really pronounce, and you're going to put it up on a very stressful Sunday afternoon, right? Inflation, price rises are just not as big a risk as they used to be, because the whole world is determined to keep inflation low.
So Ben, I think having given all that background then on inflation, QE and what have you, and we can perhaps touch upon that again more later on with any specific questions. Can you talk a little bit more about zooming out, what the global economy perhaps looks like? What we're all interested in is the shape of the recovery. And I think it was Andy Haldane, the chief economist at the Bank of England, came out the other day and put a particular letter on the shape of the recovery, and everyone got very excited. Can you share what your thoughts are on that?
Yeah, sure. So, I've been talking in the long term, like the long-term view for inflation. That can be 30, 40, 50 years. Those are the kind of timeframes I'm talking for, using 2% as a good model. In the shorter term, the bounce back from this particular recession over the next 2-3 years, we start talking about letters, and people like letters because they're a really good, simple way to get across what you mean. We've kind of drawn them on the chart here, but when we talk about letters, it's a simple proxy for saying how quickly is growth going to get back. And I want to point out a couple of things on this chart. We won't spend too long, but number one, look at 2000 and where's my little annotate thing? Sorry, I'm just if I look at kind of 2008, this one, you can see how complex the crisis was, right? You can see that it took a long time to unfold and went on and on and on and on and on and on and on. If you compare that to the current situation, we are going to be down somewhere in this V and U situation when we look at GDP. I'll put the US up because it's a good global proxy, but it's the same everywhere. the only thing that we're talking about now, the only thing we're worried about is how quickly we bounce back. Is it going to be super, super sharp because of all the stimulus? Is there going to be some impediments to everything bouncing back? The hospitality sector struggling, perhaps. Did you know that kind of the of online advertising, travel is something like 10% of Google's global revenues, just people advertising travel. And I'm thinking about it and I'm like, okay, well, I know that when I go online, most of the time when you're reading a newspaper thing, down the side of the screen, you've got things like palm trees and beaches, right? So the V world is there is some damage to some industries like hospitality, like aerospace. The U world is probably more of something the way you're thinking about a second wave of coronavirus, a lack of treatment, a lack of vaccine. And then an L world is a different scenario altogether where actually things get a lot worse than we think. Now, it's tough. I'm just trying to clear the drawings. There we go. Look at this. So one thing I think that's important, hang on, how do I now change my slide? No. One thing I think that's important is to look at where the market is pricing as well. So if you look at something like the S&P 500, the US index, the blue line shows you quite clearly, I think, that maybe we're in a V, right? Maybe the recovery is coming reasonably quickly. But the orange line, which is Amazon's share price, is pricing in a V plus. So you're getting different messages from different bits of the market. And don't get me wrong, Amazon is a company that is going to be more resilient than almost any other company to the coronavirus. But is it going to be 63% more profitable over the next few years? That's just not the case, because if there is going to be a recession and unemployment, you might buy more stuff from Amazon, but it's still not going to be kind of boosting things in the way people expect. So when we're looking at the markets, we are trying to get an idea of what can we learn from the markets about what they believe is the correct scenario that's going on, and then what do we expect to happen with those scenarios? So when I'm showing you these, and I've sort of talked through them already on the previous chart. The point is that we were trying to come up with these scenarios in around March time, right, to see what's going on. The hammer, which we refer to as the lockdown period, was pretty much in place. The dance, the long-waited kind of backwards and forwards of lockdown easing and not easing, as you know if you live in somewhere like Leicester, that's what's really interesting for the next few months, right? The arrival of a second wave of the virus is important. The response by governments is important. We are not yet in any way sure what shape this recovery is going to take, and therefore we need to consider all these possibilities.
So Ben, if we can probably agree that if the world is pricing in a V plus, and based on what you were saying there, that isn't necessarily a fair reflection of what we think is going on in the world and some of the uncertainty, what are we buyers of in a world that's perhaps a little bit more uncertain? V plus, I imagine we'd be plunging into equities and enjoying the fact that they're all at a discount because they're all about to rally. But what is it instead that you would prefer?
Yeah, so the scenario stuff I've talked about is all very well to you see it in a lot of newspaper columns, and people saying this is going to happen, this is going to happen. We actually, like you guys, you have to live in the real world, right? You have to know what the consequences are when you're in one scenario or another. You have to know what to do with portfolios, and you can see in the kind of the V and U worlds, which is where we sort of think we are, right? Probably floating somewhere in here at the moment. It's not going to be appalling, but it's not going to be amazing. For us, it's pretty clear that things like credit rather than expensive equities, right? So buying the debt of companies rather than their equity seems like a really interesting thing to do, because these big companies are not going to go bust, right? The government is helping pay the workers' wages, for one. The government is stimulating spending, for another. And these companies have just been recipients of the lowest interest rates in ever. So again, in the U world where things struggle on a bit and the equity market might pull back, those bonds are still going to get paid. So we're preferring to look for kind of opportunities in the bit of the market that sits somewhere between equities and government bonds, because government bonds at zero interest rates don't look very interesting. equities, particularly ones like Amazon that are already up 63% on the year, look too expensive. But in the middle ground, there's a lot of interesting assets. So I will point out that in about the end of March, we bought high yield bonds. So these are kind of companies that are, not quite investment grade quality, but they are still being supported in particular by the Federal Reserve. And we bought these bonds at a yield of about 10%. Now, given that currently interest rates are about 0%, that 10% yield, as long as those companies don't go bust, we don't think they will, we think is really, really attractive. People get scared for kind of the reasons I'm going to talk about shortly, about junk bonds, about things going bust. But if you have a well-managed process, we've been picking up these things at 10%. 10% income is really, really not to be sniffed at in any environment. But at the moment in particular, we think it's a really interesting, attractive way to kind of generate some returns.
So on that then, Ben, clearly what you've quite nicely highlighted is that the world is nuanced, right? The world is grey. It isn't black and white. But I think what has resonated with many of the planners that we've spoken to in a similar forum such as this before is that that doesn't always feed through into what clients see. Because what they unfortunately are bombarded with on a day-to-day basis is line charts on the BBC showing the FTSE 100 and the S&P 500 and hearing anecdotes like Amazon share price. And they probably are thinking, well, why is the world pricing in a V plus style outcome in the face of such uncertainty? Therefore, I'm a little bit worried as a result of that. So it'd be quite useful if you can run through, as we mentioned at the beginning, some of those investor behaviour traits and what's going on between their ears, so we can get a better grasp of it.
Yeah, sure. And I about 3 years ago decided to go away and start becoming an expert in behavioral economics, because look, I like economics and I like the markets, but the fact that's resonated with me over the last decade or so is that you can do all the GDP predictions you want, but actually the market is still made by people, and people respond very differently to computer models. So you need to understand how people behave if you're going to have any idea of what's going on in the market and when something's a risk or an opportunity. So quite a lot of these behavioral biases that I'm going to talk about are, I think, becoming more well known, which is great. But I think there's been some good examples of them during COVID that relate to then how people behave in the market. So let me first talk about loss aversion. Really, really common, probably the biggest well-known behavioral bias. And it was kind of first discovered, is probably generous, named academically by Tversky and Kahneman in 1979. And loss aversion is really, really simple, right? Humans hate losing. And we hate losing way more than we like winning. So in a few of these experiments that they famously done, they say, okay, we're going to toss a coin. If it lands on tails, you lose £100. We're going to take £100 from you. How much do you have to win before you want to play? And on average, people have to win about £250 before they're willing to risk a 50-50 chance of losing £100. That's really powerful, right? You are so scared of losing that you have to win 2.5 times what you'd lose before you even start to play. Now, we see it in COVID, and I've kind of put it up here, of that loss aversion, that fear of something being taken from you, that fear of not having something, is what cleared the shelves during the first phase of COVID, right? It's why there was no toilet roll left. It's why there was no bread. It's why people were kind of hunting pasta down in corner shops rather than supermarkets. Everything in you, even though you might be rational, even though you're coming home and you go, no, okay, I've got enough food in the house, everything was going, you should probably buy 2 packs of pasta and 2 packs of beans rather than the one you'd usually get. So that loss aversion clears the shelves. And the loss aversion theme runs through almost everything we're going to talk about here. Everything in your instinct will tell you, don't lose. Try to avoid pain that comes with loss. So you see it in endowment. And the endowment bias is also actually sometimes called the IKEA effect. I kind of mentioned IKEA twice now, so it sort of sound like an advert. And the endowment effect is simply that once you've invested your time in something, once you've invested your time and your money, you hate giving it up. So with the coronavirus, you know, this is, when is this? March, the end of March 2020. We were in lockdown by this point. And in Tokyo, in Japan, they were still saying, yeah, we might postpone the Olympic Games. They definitely won't be cancelled. We might postpone them for a couple of months, because they do not want to cancel something they'd invested time in. Same is true when you looked at the European Football Championships or the Premier League, whatever it is. The same is also true with politicians when they, you know, they don't give up on policies, even though it's sometimes clear that they haven't worked. Once you invest your time in something, it becomes more valuable to you. It's called the IKEA effect because they did a study, really clever study, where they watched loads of people buy stuff at IKEA and they took their details down. And then the people went home and they built their beds or their cabinets or whatever. And then these researchers rang them up and said, how much would you pay for that cabinet now, given that they'd probably built it in the last day or so? And every single time they said much higher than they'd paid for it, because they value it, because they put their time and effort in screwing it, and often in my case unscrewing it and realizing it's the wrong way around. Once you put your effort in, that really, really means that you value it. The endowment bias is really pervasive. The confirmation bias, we've seen it loads. You know, once you've come up with an idea about something, you only look for evidence that confirms your idea. You don't try and look up evidence that means you're wrong. Why? Because when you're wrong, it means you've lost. And we know that people are loss averse. So I did a really simple thing here. I looked up, was COVID made by China? I'm not sure that's the kind of correct term for how things work, but fine. And these three headlines came up, right? And people on this call will have a natural preference to click on one of these two links, simply because of this name, whether it's The Guardian or whether it's The Telegraph. And that's fine, but you've already got your bias. You already know which news source you're going to go to, because it's probably going to line up with what you say. Then you've probably got a bias to work out whether you want to do, whether you believe it was a Chinese deliberate conspiracy, whether you think it was an accident in the lab, or whether you think it's not man-made. Confirmation bias means that we find it really, really difficult to be wrong. We'll only look for evidence that confirms our beliefs. Again, this will come back to we'll come back to this on the slides where we talk about these in the markets. So the next slide, is framing. Now, obviously, I need to delete those lines, but I think the really important thing on framing is that whenever you're presented with information, you have to bear in mind that someone will have made a decision on how to present that information to you. And when it comes to something like framing, this can be really dangerous. So this I got from the BBC, I think at the back end of May, looking at coronavirus cases. And when I look at this, without having any idea of what it is, if I showed this to anyone, they'd say, wow, whatever is happening looks like it's happening all across the UK and in some size, right? Because the little bit of your brain that kind of looks at pictures doesn't read this key with the number of cases, but it looks at that and goes, wow, that looks like chickenpox spreading across the whole of UK. This is really serious. This scale, if you were to actually do the proportions on this map properly, means that the UK should be about the size of a football field to represent the genuine number of cases using these dots. But that's not what happens. So this framing, again, means that people end up being perhaps more scared than they should be because of the way it comes across. Again, it's this idea that, you know, before you consciously thought of something, your mind has already reacted. It's been loss averse, it's grabbed the toilet rolls off the shelf. Let me bring it back to markets, and you know, this is a really nice version of this chart. It's a generic chart. It shows you what's happening at any stage in the market. I saw this before coronavirus. I saw it before the global financial crisis. It tells you how investors think, and I think there's, you know, a couple of really interesting points here, right? So there's people who get in as the rally's going on, then they see it, then they see the first dip. I'll use this correction to increase my position. I think we always see a lot of people say that, and then they keep doing that as they go down. Then by the time they kind of by the time it gets down a bit further, they're selling out. Keeps going down, keeps going down, keeps going down. I'm selling out, I'm selling out, I'm selling out. Then they're happy. Good thing I sold everything. Confirmation bias comes in here, right? At 12, round down the bottom, you're only ever going to read negative things. And it's why people, financial market commentators, get so famous as Dr. Doom, or the person who saw it coming, or you read an article, I sold everything and just bought gold and guns and moved to a cave in the hills. People love reading that stuff when markets are down because it tells them that they're right. Then though, the market starts rallying again, and the confirmation bias means they're still reading the things they read down here, even as the market starts to rally again and again and again. And you get, I think, is, what the hell? More crazies. I knew this was going to happen. And finally, they buy back in again, higher up than they sold out. This investor kind of behavior, which is a really good kind of rough guide, I think we saw it, and we saw it really clearly in coronavirus. So I think, let me see, this is the FTSE 100. I remember going through January and February and talking to advisors and talking to clients. The disease in Asia sounded like an interesting, weird thing. No one knew where Wuhan was. No one knew the word Wuhan in January, pretty much, right? And then suddenly things started changing, and you started getting scared. You started getting loss averse, right? It's in Italy. Oh no, I go on holiday in Italy. Oh God, it's in the ski chalets in Italy. Wow, that really is personal for me. This is really serious, really, really serious. Suddenly there's lockdown. Suddenly you're in your own home. You can't leave. You're getting terrified. And I think then you have two really dangerous points, and we'll talk about them shortly. But one is when this is getting really serious. People panic and they sell out. They don't want to lose any more. They've just lost this first 10%. That's a really bad time. People sell out. The next really dangerous time for people's emotions overruling what's sensible, though, is as we climb this wall of worry, right? And as we get up there, Chris will talk about this in a couple of minutes. As we get roughly back to where we were before, right, where we get to the point where in the US equity market now, it's about flat for the year. The FTSE 100 a little bit off still, but rallying still. When you get back to where you were before, that's where loss aversion kicks in as well. And many people, I think, forget that. There is the immediate look, Mr. Client, Mrs. Client, you shouldn't sell just because the market's fallen. But the second wave, to kind of use a very common phrase at the moment, is once the money's got back to where it was, people will again want to say, I never want to lose money again. I never want that money to go below there. Maybe now I should sell out. And Chris, I know you've got a couple of stories of clients calling up and saying just that, right?
Yeah, and clients, but also planners calling up asking if we do have anything in order to support the conversations that they're having with clients who they've had more phone calls from, and I don't know whether or not this resonates. I'd be interested to hear from those on the call at the moment. They've had more phone calls since the market has recovered, asking the question of, is this now time to rebalance my portfolio? Should I de-risk? Should I sell? Because they're concerned about this uncertainty we talked about than they did when things sold off originally. Because at least when things sold off originally, they were able to draw a clear tangent with the fact that they couldn't go down to the local pub or couldn't go to the supermarket without queuing for an hour and a half. But this rally is something that challenges, as Ben was saying, I suppose, their biases. I think what you have is a fantastic piece of software that you're able to use to model the personal circumstances of someone and the impact based on the forecast that you have of moving to cash, for example. And we're able to try and bring those emotions under control, because as we know, the market fluctuations that can and continue to occur over time aren't the things that really hurt people. Things that really hurt people are emotions and the desire to take the reins and make a tactical decision that can be very painful. And what we then put together, based on all of the questions that we had and the requests for this, was an investor who is balanced. And what you can see here, I don't know if I can annotate this, Ben, I don't think I really need to. But the turquoise line is someone who remains invested. This is going back to the financial crisis, right? So just before it hit in 2007 to date. Turquoise investor remains invested throughout. And the investor who is in black decides to switch to cash after that initial rally. So as Ben showed quite nicely on 2 slides ago, almost that confirmation bias, I was right, spot on, Ben. This is the point at which they move to cash. And they hold cash for 12 months, because the anecdote that we always hear from people is, well, I'll put the money back in once things have settled down a bit. And as we all know, that is almost code for once the market has risen and once things have started to tick up and I feel more comfortable. The trouble with that is that all of the figures, and we have this as well if it's of interest to you, that we normally have in the back pocket, is how close those recovery days and those violent recovery days are to the worst days, and trying to call them is almost impossible. And I think this just demonstrates the damage that can be done by someone just wanting to move to cash and make that decision themselves, and to make a tactical decision on top of that which you're already doing. And as we can see, the difference here for someone who had been invested versus someone who had moved to cash is absolutely vast. A difference of £53,000 based on an £100,000 investment. That's significant, and that is the sort of thing that damages someone being able to meet their objectives. We've got loads of stuff, by the way, on this that we've been putting together in the interest of being bipartisan. Vanguard have done a great piece in this that you've probably also seen. Just anything, I suppose, that stops people worrying and enables them to relax their shoulders slightly, in absence of you being able to do a full-on forecast and bring them back to their plan. It's a holdover, if you like, until you can get them thinking rationally. And on the topic of thinking rationally as well, I think there's something really interesting, some lessons from history that Ben's going to talk about, because as opposed to just trying to overlay letters from the alphabet on top of GDP for countries, and you can see clients glaze over, sometimes using something interesting and something that grabs the attention to give them context is really useful. And this is a piece, I'm not going to ruin it for Ben, from Capital Economics research house that I know that we use, which does this, I think, beautifully. So Ben, can you talk through this well-known figure from history and how perhaps you can draw tangents for today?
Yeah, sure. I'll be really quick because I'm aware we've talked a lot. But yeah, these guys, I wish I'd done this bit of research because it's really cool. Just went through Samuel Pepys' diaries, right? And he was in London in 1665 when the Great Plague came. And the Great Plague was really, really bad. Like, loads worse than coronavirus. 25% of London died in the kind of 6-month period. So, you know, that's quite a lot worse than coronavirus. And what they did, these researchers, which I love, was they just counted the times that Samuel Pepys talked about certain things during the Great Plague. So on this slide, you can see he starts talking about the kind of the Great Plague or the sickness in kind of the start of 1665. You know, just about the time, really, if you use our analogy, we were thinking, where's Wuhan? Then the death rate really, really increases, and he's still talking about it, still talking about it, still talking about it. Then by 1666, kind of it's peaked in 1605. By 1666, the plague deaths have decreased, but obviously he's still talking about it because, you know, we're going to talk about COVID for a long time as well. So that, I think, is quite interesting, right? Just if you compare Samuel Pepys to modern media, I think that line, this blue line of plague references, is pretty accurate. You know, we'll keep talking about this until something else comes up. As a quick heads up, in about 1666 here, in the middle, is where the Great Fire of London came up. So he suddenly had something else to talk about. But let's go back to human behavior, right? Because lots of the biases I told you about are there in everyone. I think Samuel Pepys is a pretty good role model for all of us to think about, because they also do it when they look at his references in his diary to his office. And so he went back to his office. He fled London and went to Greenwich, which wasn't in London back then, in May 1665. But by January 1666 was back at his office in the city, even though the plague had, you know, only really started falling in September. 3-4 months later, he's back in the office. January back in the office sounds pretty familiar, given everything everyone was saying at the start of this call. The thing I really like, though, is that they also count the number of times he goes to the pub. And by Christmas 1665, he was back in the pub. He maybe wasn't there quite as often as he used to be. But what's really telling is, you know, again, this is like a direct analogy. I kind of wonder whether the government's getting policy advice from Samuel Pepys' diaries, right? We've opened the pubs before we've opened the offices, and people have flocked back to them. So there's the direct comparison to behavior after plagues or pandemics. There's also the final thing I want to draw your attention to, which is that, look, this is like 400 years ago, and we're still talking about offices, about pubs, and about how people live their day-to-day lives. Humans really haven't changed that much. We've got iPhones now, so Samuel Pepys would be writing a blog rather than a diary. But my take on how our behaviour will respond post coronavirus is we'll be resilient. We've been through this kind of thing before. We haven't been through it with exactly this technology, but that will make us better placed to grow and recover, even more quickly than Samuel Pepys. And also, fingers crossed, there won't be a massive Great Fire in the middle of London next year. Once we can get past that point, I think we can pretty safely say history isn't repeating itself. So we think human behaviour is going to change. It's going to stay the same, and the economy will recover, I think, a little bit more quickly than people expect. Back to a place where life feels, at least, a little bit more normal. I think that's it from Chris and I, but happy to take any questions. I think we went a little long there, but if anyone has anything.
That was absolutely fantastic. Thank you. I really like the last part of that as well about Samuel Pepys. I think that would be great. I mean, planners, that's something for you to use really with your clients as well. Will you be able to send us the slides so that we can send it to people?
Of course, yeah. The Samuel Pepys stuff, yeah. If you take away nothing else, that's a really good story to, I think, remind people about.
Yeah, and then separate to that as well, if there's anything else that you might find of use from a managing client emotion side of things, we've done loads of work in that area. So just drop us a line. Always delighted to share any of the research and pictures and what have you that we've done to try and help out.
I was interested as well about your inflation point, talking about the difference between now and 30 and 50 years ago as well. I think that's something that consumers don't take into account at all.
Yeah, I think it's a really, really good point. People are still scared of inflation, but actually the last, however many years has been reducing the cost of goods. I know it doesn't feel like it with iPhones, but 20 years ago, you had to buy a computer, a Walkman, a microphone, a video recorder, and a TV, and that cost you way more than the 800 quid that an iPhone costs now. It really inflation has become structurally lower in the world. You get way more for your money now than you ever used to.
Great.
Based on that, Ben, what is a reasonable assumption over a, let's say, 20-year, 40-year, 60-year period for inflation?
I think I mentioned it during the chat, but I think the 2% target from central banks, is a really, really good one to use as your base case assumption, because number one, they are actually targeting it, and number two, they've done the research for you, right? These central banks didn't just pluck 2% out of the air. They had economists studying for, in a couple of cases, like 20 years to work out what a healthy amount of inflation is. What is it that gets people still out there spending, but doesn't go so far away from the norm that people panic? And 2% is the number that pretty much every economist and every bank in the world agrees on and targets. So over the long term, 2% is absolutely where we'd expect inflation to be.
It's quite interesting, because I think I'd probably be right in saying the majority of the room, when you're planning with our system for your clients, probably uses somewhere between sort of 2 and 3%. Yeah, I've occasionally seen 3.5, but 2 is the absolute minimum. It's quite interesting, if you're you guys think 2% is going to be the inflation rate. Everyone's probably slightly overdoing it, but it's probably the cautious approach, which I suppose is the right thing to do.
Yeah, I think that's probably fair, but yeah, the saying that inflation is going to rise and rise and rise is kind of saying that prices won't keep dropping. And as a sort of side but definitely related point, we don't invest in commodities directly in our portfolios, but kind of from a structural point of view, because over the long term, commodity prices fall. And commodity prices fall because there are lots and lots of smart people out there in the world whose only job is to work out how to get stuff out of the ground more cheaply, grow food more cheaply, and I guess in a couple of cases kind of extract precious metals and sell them to jewelers more cheaply. Betting again, kind of when you say, oh, inflation is always going to go up because prices rise, it's kind of a bet against humans continuing to be innovative, which is not a good long-term bet. That would be a really strange thing.
And that is one of the reasons why, that's the argument against really looking back sort of, for the average over the last 50 years, isn't it?
Yeah, absolutely. I think the thing, the 70s period of really high inflation was partly due to high oil prices, unexpectedly high oil prices. There's so much competition in the world now and so much technological invention that, number one, I'm not sure oil will be the metric that that is the one to look at for the next 50 years. And number two, even if it is, prices in oil are, the danger is always to the downside, as again we've seen in coronavirus.
Can I ask a question of Ben? Would that be okay?
Yeah, sure.
Interesting talk. What I heard you saying, but I may be wrong on this, is that the normal relationships between printing money and inflation, or printing money and making bonds a weaker investment, is that everybody's doing it. So investors might be getting nervous, but the Germans are doing it, the Americans are doing it, there's nowhere else to go. And therefore that's the argument that it's okay. And I'm thinking to myself, well, supposing we use a different analogy of building bridges, and we made our bridge very weak. And so investors are saying, I'm not going to go on that bridge. But if everybody else is making their bridges weak, well, surely to goodness, one of those bridges is going to fail. And, I'm taking this into the context of, I remember, I think it was Jerome Powell, was it 2018? He made a big announcement that, we were now going to start normalizing interest rates, but they haven't been able to do it. So, I'm not trying to be sort of a difficult person asking this question, but I am genuinely thinking to myself, this is different. We haven't seen this in our lifetime. We haven't seen it in centuries, and the whole world is doing the same thing. They're all building weak bridges. So I don't know. What do you think?
I think I guess I wouldn't use the word weak rather than the whole world. I'd just say the whole world is building bridges, and we all know why. Because one of the reasons that inflation accompanies money printing so often is because money printing is a sign of desperation. It's a sign that you as a country have lost control of your debts and that you have not been able to run a successful government spending program. I believe this time is different because every single country in the world knows why the government spending programs have increased so much, right? It's on the news every single day. It's to tackle the coronavirus problem. So I think there is a point more of kind of understanding and leniency, right? So inflation only comes, currency weakness only comes if you sell someone's currency and go and buy another one. And the reason you'd buy another one is because you think, oh, well, they're handling the situation better. Now, I think you are right. There will be relative differences. It may be that, I don't know, Germany doesn't print quite so much money, and everyone thinks, oh, actually, the euro is a little bit better than maybe the pound. But I think it's so uncertain, and so the advantages will be so marginal that it's difficult to say that there's going to be runaway inflation in one particular place. There's probably a caveat on, I'm not sure South Africa has got this nailed, and I suspect their currency will get a lot weaker. And there are probably a couple of other countries where that's true. But for the main countries, for the UK, for US, for Europe, I don't think it's a unexplained, unexpected panic that causes inflation. With regard to Jerome Powell in 2018, they did try and normalize interest rates. Like interest rates in the US got up to 2.75%. Don't get me wrong, there's still probably a little bit of a way to go, but they said normal was about 3.5. So they nearly got there, and then coronavirus came. So I'm with you. It seems like a really long slog back from the financial crisis, The US was getting there. The UK was going to be raising interest rates were it not for the kind of Brexit delays. The European Union we were looking at just before coronavirus was talking about exiting negative rates. The world was kind of moving really slowly back towards a normal interest rate world. And then coronavirus came and threw it all up in the air. So I still believe that central banks want to normalize policy and get interest rates back up. But I think they found themselves interrupted.
David, what are your thoughts? Hello?
Sorry, Sandra, what was that, son?
I said, I wondered what David thought about that.
But what are my thoughts about I the moment? I think I would be quite concerned about the situation for another month or two. I haven't really understood why the markets have started to rally again. But maybe I'm showing behavioural bias. Probably am. Yeah.
Well, guys, do you want us to move on and let Raj show you the capital chart just to demonstrate some of those points that Ben was talking about?
Yeah. Right. I mean,
and Ben and Chris, before we start on that, if you wanted to, you can stay, or if you need to leave, because I know the budget was yesterday and you're very busy and so on. You didn't have a chance to tell us about your seminar that you're going to be doing on the 20th of August, and that's for truth users again. Chris, do you just want to have a quick word about that?
Yeah, if that's okay. It was just to say that we've touched upon, I think this is the third session we've done with truth users so far, and the feedback has been great, and all of the, particularly the behavioural aspects that are linked to what's going on in the world. And we've worked really hard over the course of the last 2 or 3 years to, almost in preparation for an event that we didn't know was going to happen, to try and look into the best way of withdrawing income for clients regardless of the weather. And there have been multiple letters that you would have all received, Dear CEO letters from the regulator, MiFID II and PROD, those wonderful acronyms have made your jobs more complicated, and has led us to a lot of research into the areas of everything from structured products to discretionary sell down to annuities, to having a framework, I suppose, that provides a consistent method of drawing income and managing client emotion. And I'll come back to the emotion point again, because it often is the most damaging part. So what we are going to talk about on the 20th is the research that we've done into income in retirement, particularly in an environment of incredibly low bond rates and very tight regulation, and rightly so, and some things that you might well want to explore. So we'd be delighted if you could join us. Again, hopefully if you've joined us for 1 or 2 of these, they're insightful. It's not really us just throwing things at you and ending up with, wouldn't you like to buy one of these? It's food for thought. We genuinely believe that planners need to be at the forefront of this and grabbing all of this by the scruff of the neck, because clients need them. We want to support you in any way we can.
Fantastic.
thank you, Chris.
Sandra, we will leave you if that's okay. But clearly, if there are any questions that arise, I just saw the reaction from, I can't remember the name of Asa. If there's anything else anybody would like to ask in due course, Sandra will circulate my contact details. Drop us a line. We'd love to hear from you in any context. So have a fantastic afternoon.
Brilliant.
Thanks.
Thank you. Thanks for your time. Take care.
Bye for now.
Right, guys, I just literally want to cover, I mean, it's stuff you guys do anyway, what they were talking about in relation to the software and how you can show certain things and, you know, different aspects of it. So, I mean, the reason I'm looking up, by the way, oh my God, thank you, Kevin. The reason I'm looking up is everyone's faces on my top screen, so ignore me for doing that. And feel free to unmute yourselves and just join in whenever you want. Right, going back to V shapes, V pluses and U's and everything else they were describing. typical cash flow here. This is my demo client, and the actual chart doesn't really matter. Sort of things you guys are doing quite normally is capacity for loss. So, this client here retiring at 60, it's got a problem very quickly, sort of mid 70s. They run out of money at 75/76. So, sort of things you guys are already doing. Capacity for loss. What if everything suddenly dropped by, and I think again the room will be using sort of between 20 to 30%, I think. No one sort of going much higher than that or much lower, so we did 25%, and let's say no recovery, worst case scenario. There you are. So again, stuff you're familiar with. So this cash flow would run out nearly 10 years earlier, as you'd expect. Realistically, and again going back to their point, there will be a recovery, but the question is how soon. And if looking at their slides, they were talking about 2 years, which I generally don't think the room here is using 2 years as a recovery period. It normally varies between sort of 4 to anywhere up to 10 years normally, from what I've seen. So again, if we put a 5-year recovery period in, because this client's not retiring for another 10 years, in 5 years' time, they'll be back to where they were. So it has no long-term impact on their chart. What I've done as an extra step, based on what they went through, is a couple of things. So I'm not sure if you guys are having this or not, but they're having clients asking them to move their investments to cash. So, I've created a scenario where all those investments are actually moved into cash. So bearing in mind, if nothing happened, this cash flow would run out of money at 75. If there was a market crash and it recovered, it was going to run out, make no difference. Or if there was a 25% drop and it never recovered, it ran out at about 66, 67. So if they were to move to cash, how would that look? And I think we all know straight away it's actually worse off than a crash, and the crash never recovering. So in this case, they'd run out sort of 64, 65. Whereas if the markets crashed and never recovered, which was here, they'd run out of money sort of 67. So, the point being, panic clients and sort of moving to cash isn't a good idea, which, you guys all know anyway.
Raj, can I ask a question?
Yes.
Please. To demonstrate the draft scenario, was that how you did that? Was that just by opening up a draft scenario and then going into each of their existing investment products and adjusting it to a 0%?
What I did was I actually excluded all the investments and just created one big pot in a bank account at 0.5% interest.
Okay, thank you.
Just for demonstration purposes. I mean, I don't really see anybody needing to do this.
Yeah.
To demonstrate it to your clients, but this kind of fit in well with what they were talking about.
Okay. Yeah, thank you.
The next step was they also have clients, and I mean, this may sound familiar to some people, where clients may want to move into cash until the markets start recovering and then reinvest at a later date. So again, a bit of legwork, but what I did then was actually create a scenario where they move to cash and reinvest in 5 years. So this one now runs out of money at sort of 68. So what I've done here is all their investments at the moment, which were sort of growing at 4 or 5%, have been moved into cash, and in 5 years' time, they've been reinvested at 4 or 5% again. So I suppose really here, what we're comparing against is the market's recovering. Because that's what this scenario would sort of imply, that, you know, this investor was pretty sure that the markets would recover, and in 4 or 5 years, what they would do is move out of cash and back into, you know, back onto the markets. What they're really doing is they're losing out on all that sort of accelerated growth in between. So the comparison for this scenario, where they would run out of money at sort of 68, is if we go back to the current position and simulate sort of staying invested. So if the market's dropped 25%, I mean, the percentage can be whatever we want it to, but the key being they recover in 5 years' time, you know, their cash flow has no long-term impact. They're running out of money at 76. Instead of, if they move to cash for 5 years and then reinvested, they've knocked nearly, what, 8, 9 years off their cash flow chart. So again, you know, this is stuff you guys are talking to your clients about anyway and know this, but just sort of demonstrating it in the software. The other point they made, which I found really interesting, was inflation. So going back to my original sort of scenario, and, you know, let's forget about market crashes. I've got inflation at the moment set to 3%, which I think is a sort of, I think it's a middle ground personally. You know, if Ben was here, he'd probably say that's probably much higher than it needs to be. And, you know, generally speaking to you guys, I think generally speaking, I'd probably say it's even between 2.5% and 3.5% people use. You know, normally if people are doing DB work, it tends to be sort of 2.5%. 10 years ago, there was an argument to say it's probably between 3 and 4%. And, you know, some people may still be using those sort of numbers, but generally speaking, it's between 2.5% and 3.5%. What I found interesting was this scenario has inflation at 3%. All I've literally done is copy the scenario and change inflation to 2%, which, you know, falls more in line with their expectations, Ben's and Chris's. And suddenly the impact is quite dramatic. You know, that suddenly solves the problem on this chart.
I mean, I think that's amazing. You know, it's such a stark.
I mean, what we've got to bear in mind here is suddenly that investment that was, you know, let's say 4%, whereas on the black line, it's getting a 1% real return, is now suddenly getting 2% real return compounded.
I ran some scenarios a couple of days ago. I don't run them every day, so I'm not one of the massive users, but I couldn't believe, because I did that as well. I dropped inflation down. I run inflation at 3%, and I dropped it down to 2.5%. And I was staggered by the difference it made. And when I started looking at things like future income streams and linking them to RPI as well, or withdrawals and linking them to RPI, I was absolutely staggered by the difference that made as well. I just didn't realise that small movements in even a 1% increase in drawdown benefits, huge differences to the cash flow.
It's the compound effect, isn't it?
Well, I appreciate, yeah, it's inflation on inflation, yeah. But until you actually see it, like you've just done there, you know, I mean, that's a 1% difference in inflation. So somebody who's got a huge problem, like, you know, or potentially a huge problem of running out of money at 77, well, if inflation is just, you know, 1% better than what anticipated, then they haven't got a problem at all. And